So the plan is to, yeah. So we have had the past, how many days now? 10 days. We've had a huge range of topics covered. We started with macroeconomic theory, talked about the various ways in which looking at theories from various perspectives in macroeconomics. And then we talked about microeconomic theory, looking at what is the general equilibrium nature, how does the price mechanism work, or it doesn't work. The mic fellow? Oh. So what are the problems with the price mechanism? If you have asymmetric information, incomplete information. So we had a good grounding in kind of basic economics that, at graduate level you have. It's not thorough introduction, but we reminded ourselves of what is there in theory and how it's been practiced and all that. And then we had the mathematics of the pricing of financial derivatives, financial instruments. And that is quite important part of the story, that what's been the crisis, some of the problem in terms of pricing complex derivative products. So where do these pricing formulae come from, and what is the theoretical underpinning of this pricing? So this is the entire set of lectures given by Mrinal and Srikanth on various aspects of using stochastic calculus and the mathematics of complex derivative pricing and so on. And then yesterday we had this what we call as the heterodox way of looking at macroeconomics, or the alternative way of looking at macroeconomy, which is not new, which has been there for a very long time. It's called the stock flow consistent accounting framework. If you look at macroeconomy as a structure, as an accounting structure, then there are ways to understand what happened before the crisis and why there was a sudden abrupt crash in the financial market followed by long-term stagnation in Europe, and US is slowly picking up right now. So how does this happen? So there is a framework that is there, and there is a set of models and theories have been developed over the past number of years. In fact, those theories actually predicted the crash before the crash happened in 2008. But anyway, that set of there was an overview given by Zezza from Italy. So you all looked at some kind of at least an introduction to how they actually work. So from what I'm going to do right now is to just combine or just bring all this together to see where we are going from now, from today, tomorrow, and day after tomorrow. Because we need to create, it's always been, not always been, in most cases, finance is developed on its own and macroeconomic theory is developed on its own, right? And the interrelation between why is that in a financial crash, you have unemployment to 25%. In Spain, the youth unemployment is 25 to 40%, and average unemployment in Europe is about 10% across Europe. It's not just one country, two countries. So what is the connection? What is the interconnection? How are we going to understand, theorize this, and so on? So this is what we're trying to grapple with, and that's what's going on in terms of macroeconomics and in terms of policy. As you know, the dominant policy models have completely failed, and they're still persisting in most of the central bank. They're still persisting with the same kind of models and so on. There's a fight going on at a policy level. There's a fight going on at an intellectual level. There's a fight going on at a political level. Okay, all levels there is a struggle that's going on, and there is a struggle going on at the students level, where we talked about it, that UK and US, a lot of students talked about we want diversity in economics teaching and so on. So So what I'm going to do is I'm going to go back, remind ourselves a little bit of where does, remember when Anjan Mukherjee talked about macroeconomics, he said, well, it's about dynamics. When you think about microeconomics, fine, it's all right, but macroeconomics is evolving over time. So how do we kind of understand dynamics, and what is the dynamics that we're talking about? What is that we want to understand, particularly in the context of the financialization, as we say, from the 80 onwards, there was an intense, massive developments in financial markets, capital markets, and intensity of financialization. That is the non-financial corporations investing heavily into financial markets, and thereby, they're impacting their decisions to produce output and provide employment in the real economy. So this is the context in which we are looking at it. So in this context, how does the financial variables actually affect the the real variables, so to speak, the output, aggregate demand, output, employment, and so on. Okay. So I'm going to start with very simple demand and supply models that we all have studied. That seemed to have gone somewhere. Anyway. Crashes always happen in macroeconomics. Sorry. Okay, sorry about that. There was some. Okay, I'll go back to this lecture. I'll use the lecture that I do. So if you think of think of market dynamics in a simple way, we have so this is think in terms of time. So quantity demanded of any product is a function of current price, right? PT is the current price, and we all know this is the so-called law of demand, right? As B is negative there, that means as the quantity demand price is very high, quantity is demanded is low, and price is low, quantity demanded is high. So this is the so-called law of demand. Whereas the supply, in this case, supply is determined by last period's price. So think of agricultural commodity. So if farmer gets a potato price, if the potato price for his product was good last year, is going to produce more this time period. So this is your basic demand and supply curves. And the equilibrium is basically when demand is equal to supply in the market. So if the way we teach economics in graduate, micro or undergraduate level or graduate level, we say that I'll just switch on the lights. Yeah, that's fine. So we do this. We have this demand and supply curves, and we invert the axis. We don't use the price here and quantity here. We do price here and quantity here, quantity demanded or quantity supplied here. And we draw this kind of curve. This is the demand curve, and this is your supply curve, right? And this is like every textbook, we start with this kind of simple, okay? Now, these are the equations, okay? Now, if you actually go through the logic of this equation, this is, if you equate demand is equal to supply, yeah?
Why supply price doesn't depend on expected price?
Yeah, we'll come to that. This is the simplest model. First we start with simplest possible way, and then we'll generalize or complicate in terms of. So that can be actually, if you take that as expected price, think of the suppliers are naive. They expect whatever happened last period will happen now. Okay, let's start with that naive expectations case. So if you go through the system, suppose you start with some out of equilibrium price, right? So you start with this kind of some price. So this is your equilibrium price. We all know that demand is equal to supply. That's where trade actually happens. So think of your buying a house, or so you start with some price. So at this price, say P naught, this is the quantity that the demander or the consumers will say, I want to, this is the amount of quantity that I will demand for this price. And the suppliers will say, oh, well, this is the quantity that I will supply in the market. So obviously there is a excess supply in the market. They don't match. So knowing that, so this is the first time period. You start with some initial price. Knowing that this is the price that the suppliers are, or this is the quantity that the suppliers are willing to pay for this price, the consumers will say, well, for that amount of quantity, I will pay this much price, right? And iterate this further. So you'll say, okay, if this is the price that you are willing to pay for this quantity, then the suppliers will say, well, I'm going to, for that amount of price, I will supply this much of quantity. So if you iterate this process, you will basically converge to this equilibrium, right? This is the haggling or the process of how market actually arrives at the equilibrium price. So that is the price at which you are price and the quantity where actual exchange happens, right? Now this is simply solving a first order difference equation, right? If you equate demand and supply, you will get the actual exact solution for this equation, and the exact equation is this, that's given by. So you can think of this equation. This is the solution for that first order difference equation. Demand is equal to supply. Starting from any initial price, this is your equilibrium price. The stability condition, this process will converge to equilibrium when? Only when this stability condition applies. That is, B1 divided by B should be, mod B1 divided by B should be less than 1. Right? What is B1 and B1? B1 is the slope of the supply curve, and B is the slope of the demand curve. Only when this is less than 1, this process will converge to equilibrium price. If this is greater than 1, this is going to be unstable, or the exchange will never happen. Right? Exchange, you will say one price and the seller will say other price, the exchange is, so the market will not converge at all. Now, so B1 by B is a stability condition, right? B1 is slope, B is the slope of the demand curve, B1 is the slope of the supply curve. So we always look for stability conditions. So when you talk about markets, or when you talk about macroeconomy, we'll come to the next slide, is the macroeconomy. So in any case, when a system is growing, okay, we are two parties involved, we want to know when does this converge, because we are interested in this, the condition under which this market converges, so that we can, like, when does this financial market get to a stable equilibrium? We want to know that, right? So for policy and so on. So next, this is at the micro level. So if you think of the stability condition, B1 by B is less than 1, you can figure out what does that mean, how does the convergence happens, does it, and then it's an oscillatory convergence because of, you can draw time series of price and T and see how this convergence happens. If this is, let's say if 0 is P, if it starts from any initial condition, does it converge like this? Okay. Or, so stable case starts to converge like this because the slope of the demand curve is negative, so it'll oscillate and then it'll converge. If it is greater than 1, obviously it's not going to converge. Starting from any initial condition, it's going to blow up. Okay, it's going to be unstable. Or you will have the case equal to 1. You'll have some case called limit cycle. I won't get into the technical details, and Vishu and Petri will follow. Okay, this is your question, the general. If you generalize this equation, if you take that as the expected price, supply is a function of expected price. For naive expectations, you get the simpler model. For adaptive expectations, you will get this is called some adaptive expectations formula, expecting some normal price case. So you can have this kind of expectation formula, and you can look at the speed at which it's converged to the equilibrium condition, or you can go to rational expectations or further complicated expectation rules that you can give. So this is at the micro level. So we understand this, right? Similarly, at the macro level, what do? It's, if you consider in the mainstream economics, individual is also a macro. So there is no distinction between an individual and the macroeconomy. Now, in the macroeconomy here, if you have the slides, I'll put it up. So I go back to other slide. So in the macroeconomy, you can see this is what we do, right? As we all know, we are not building the macro from the behavior of individuals, like micro-founded macro, no, but we are looking at the structure of the macroeconomy. So from the accounting structure, we know that on the expenditure side, you'll see, you calculate all the expenditures. So you'll see the national income. And we do multipliers and so on, right? We have done this before. So 1% increase, see, in exogenous demand, like government expenditure or investment expenditure, what happens to the output, okay? So we know this, and we know how this process, we always have drawn this Keynesian cross diagrams, planned investment and actual investment, planned or actual to planned investment. And then this is the 45-degree line, and this is your C plus I plus G curve. And if you increased something, you have this multiplier amount of output. All this we have, studied. But underlying this process, the stability of the multiplier depends on certain conditions. And that condition is what your marginal propensity to consume less than 1 and so on. These are crucial stability conditions that they're lurking behind that we don't act. This 1 minus B is the condition under which this will converge to the new equilibrium. Now, In the macroeconomy, okay, so we know that, well, in the Keynesian case, your investment, drives output. This is the Keynesian multiplier. So consumption is again a function of some function of income, right? We talked about the simultaneity. You can think in terms of past periods, income, and so on, and investment. So the case is within the Keynesian economics. How do we understand the generative mechanisms of cycles and fluctuations? And this is the model, the famous Samuelson's multiplier accelerator model in 1939, that he talked about. Well, if your investment is, if you increase your investment, your output is increasing, okay? But when output is high, when the climate is very good, people want to invest more because it's going to bring good times. People think, oh, I'm going to invest in this country because output is high, so that's going to further increase your investment. So where does this cycle end, or what is the property of this dynamics? So he tried to show that actual economies, they actually show a lot of fluctuations, cycle, all kinds of dynamics. Okay, it's not just about linear growth or monotonic growth. There is a huge fluctuations, and we have seen that there are sudden crashes. We'll come to this, abrupt crashes and so on. So Samuelson tried to look at this. He didn't start the business cycle literature, but he contributed to this, saying that, well, within the Keynesian framework, if investment is increasing output to multiple times, in turn, investment should be increasing in the system because everybody will be optimistic and so on. So this is where the multiplier accelerator model. So if you think same thing, CT plus IT plus GT, I'll just go exactly to the multiplier, that model. Yeah. So if you assume that your investment is a function of output like this, so it depends on last period's output. So this is going to have a feedback into Y. So this process will go on. So he tried to look at the stability of the system. So this is the interaction between multiplier and accelerator. So this term is the accelerator, and this term is the multiplier. So our output is, multiplier term. So this is the entire structure of, this is the model. What did I do? Yeah. Oh, something wrong. It's all mixed up. Sorry, just one sec. Yeah, that's all. So this is the way he sets up the model. So starting from YT equal to CT plus IT, and investment is a function of last 2 periods consumption. Basically, it gets this, how investment is a function of output. And if you substitute back into the equation both consumption, which is a function of last period's income, and investment, which is a function of difference between last 2 periods of output, which is the acceleration. So the coefficients B and the B and K, or the K is the acceleration coefficient, B is the marginal propensity to consume. The interaction between these two produced a lot of dynamics in this model. And this is the multiplier accelerator model, which is kind of classic model people study. And if you actually solve the system, this is the equilibrium condition, equilibrium output, Y star, G is the government expenditure over 1 minus B, B is your MPC. And if you solve, this is the second order difference equation. If you solve, you will get lots of dynamics. And he plotted this in the parametric space of, K is the accelerator coefficient and B is the marginal propensity to consume. So if you fix the marginal propensity to consume, and if you moved on the horizontal line, that means if you kept increasing the accelerator coefficient. So for very, very small values of accelerator coefficient, that is less than, let's say 1, accelerator coefficient less than 1, in this region A, you will have a monotonic convergence to the equilibrium value. So he showed that if you started in that region, if you started from any initial condition Y naught, and this is T, suppose this is your Y star value, or if you take Y star is something here, so you'll basically monotonically converge to that value and stay there. And in region B, you will have oscillations, but the oscillations will be dampened. So it'll converge, oscillate, and it'll converge. And C, it will basically you will have oscillatory explosion, and that's the region C. And D, he showed it's like it just explodes. That's it. It will explode. It will never converge. So he showed possible dynamics that you can actually. So all that he tried to do was, what is the generative mechanism? It's not curve fitting, or he knows the real output actually creates a lot of fluctuations and generates different dynamics. So he tried to give one plausible way to understand generative mechanisms of how these dynamics can happen. This is up to the Samuelson multiplier accelerator model. But then you see the Keynesian economics, Keynes himself, if you read 1936 book, he was not bothered about, he was not bothered. He didn't talk about income distribution at all. Okay, he's simply, he took income distribution as given between people or between classes. The whole story of combining income distribution and output, you can obviously think that if you have income distribution is very bad. So there are a lot of people who are earning profit and people who are earning workers. There's a huge disparity between these two groups. And if you assume that workers consume more, out of all their income, if they earn 100 rupees, they'll consume all that income, whereas profit earners consume less. So income distribution has an impact on output, right? And this was actually realized. Michael Kalesky was he actually formalized. He's the actual unsung hero of macroeconomics. In return, he basically said, well, income distribution actually affects, he showed the same multiplier relation through income distribution, impact of income distribution, how it actually affects your output and so on. So if you take, this is the story. So this is your, okay. You can calculate national income by expenditure method, or you can calculate national income by income method. If you calculate by income method, this is your profits, and these are the wages. Now, these are the respective shares. So if you divide by 1, profit share and wage share, okay? So this is H. Let's denote this as H, and obviously this is 1 minus H. So this is the profit share, and this is the share of wages in the national income. Now, there's a class of models that came in that spirit in the 60s that how does, the dynamics between this profit share and output, or if you want to say it in different ways, the dynamics between wage share and employment. So if I increase my profit share, yes, investment will increase, but at the same time, consumption will fall. So increase in investment, if it offsets the fall in consumption, then obviously your income output will go up. If, on the other hand, if consumption fall is more than outweighing the rise in investment, then you will have a fall in output. So there's a class of models of this type, starting from Goodwin, who uses this predator-prey class of dynamic models to show how the dynamics between profit share and employment, or in terms of wage share and employment, can actually create kind of fluctuations and dynamics that we see in the real life. Now, on top of that, now what we see, and remember the first lecture that I was talking about, and in this period of, Kalesky also talked about principle of increasing risk. He also had a notion of financial market, but he didn't develop it in a way. But now all these models, in a sense that you don't have finance, there's the role of money itself, it didn't play a dominant role. Now, during this financialization period from the 80s, what we saw, as you saw in the first lecture, that if you look at the income distribution from Piketty data, if you look at the personal distribution of income, or if you take into size distribution of income, or if you take this kind of a class distribution or functional distribution of income, you do see the influence of financialization into this. So you have within the top income earners, if you want to take in terms of personal distribution of the income from production is 1. Sorry, the income from production is 1. So income from, this is all economic growth. I don't want to get in. So the Solos model, I don't want to go there. So income, not only you have within the financialization literature from the 90s, what you see is that if you take in terms of profit share and wage share, you have income from production, real income, let's call, okay, the profits, and income from dividends and interest, okay, income from holding financial assets. Similarly, these guys will also have their wages and the financial income of the households. This is the, let's say, firms and financial income of the households. Now, this has impact in terms of your disposable income and so on, as we saw in Zedza's thing, Zedza's lecture. So you have the financialization or the financial market sitting on the one hand, actually influencing your real expenditure through its financial assets, people holding their financial assets and so on, through their savings behavior. Now, if you want to bring this in, then so that's the financial market, and that's what your savings is in the financial market. You don't save only in cash. You also save in terms of other assets like equities and securities. So you have the financial market, which is doing its own thing, and which is actually affecting your output and employment in ways that we are still discovering during this financialization process. So if you want to combine these two together, if you want to understand this entire in totality, so you need to have a consistent accounting basis, right? And you cannot, you need to have a systematic accounting basis in terms of how these guys are connected, in terms of the institutional description of the macroeconomy. So what are the sectors that we are talking about, and how are these sectors are related? And in there, you are talking about how these implications of holding financial assets and so on come into actually affect your disposable income, and thereby output and employment, and thereby thinking about crises and crashes. So what we saw, so when you look at the kind of financialization, financial markets, this is what happens in the financial market. You have lots of crashes, these kind of abrupt crashes that we saw in major crashes, right? You have sudden crash that happens. So there's a prolonged boom that happens before the crash that we 2004, 2005 onwards, based on property, based on debt-led consumption-driven boom that happens, and then every crash is different, but there is an abruptness of the transition, and then the economy lingers in this state for a long time, in the recession state for a long time. Now, the modeling this kind of dynamics is first done by Christopher Zeman. I mean, he used Zeman. I'll show you the paper. Christopher Zeman is the name. Maybe I'm saying it wrong. Christopher Zeman. So that paper, 1973, I think 1973 or 74, that paper actually uses this is the paper. So this is on the unstable behavior of stock exchange. So he actually tried to model the abruptness of the crash using catastrophe theory, okay? Now, this is a classic. This is an absolutely classic paper, forgotten, and I don't think even in finance departments they actually do this paper, and also other papers that he did. So he basically starts with, he says, well, what is his main problem was some of the unstable behavior of stock exchanges can be explained by a model of catastrophe theory. That's a simplest way he starts. A similar model can be applied to currencies, property market, and other markets that admit speculators. So he's basically, he wants to have a very simple model that can explain this kind of abrupt behavior, abrupt kind of crashes in the market. So he starts with two types of investors, chartists and fundamentalists. And fundamentalists are the one who go after the fundamental value of an asset, whereas chartists, they go after the trend, or the speculators, because they look at the trend and trade. So he says C is the proportion of chartists. The whole idea basically is trying to say is that if the proportion of chartists increase very high in the market, then the market is, because speculators are very high, then the market is liable to sudden crashes, okay? That's the hypothesis that so he says, we ask the question, how are the variables C, F, J are related? So what is J? J is the index, okay? J is the Dow-Jones index, and which is the rate of change in the value of that index. And if J is equal to 0, then you can say it's a static market. J is greater than 0, it's in a bullish market. If J is less than 0, it's a bearish market. And it applies to other currency or whatever he says. So you have two types of investors, C and F. C is the proportion of speculators in the market. F is the proportion of the fundamentalists in the market. captured by the excess demand in the market. So he asks a question, how are these variables C, F, J related? It's a beautiful paper. It's a very good paper. You'll see, when you talk about dynamics, he actually brings about the time scale issue. The way you'll see immediately. Of course, the question is too naive because they will undoubtedly be affected by many of the other external factors. As a first approximation, let us suppose that there is a dynamic relation between them represented by the ordinary differential equation between C, F, J. Okay, J is the index, C is the chartist and fundamentalist. So he says to build a qualitative picture of the flow, we shall take as hypothesis a number of observed qualitative features of stock exchanges and currencies and translate each feature into mathematics. It transpires that all mathematical features can be synthesized into single mathematical concept, namely the cusp catastrophe with a slow feedback flow. See, this is quite important. The feedback, the rate at which the system is feedback into different variables. So the feedback of Y affecting C and the feedback of Y affecting I, there may be two different time scales. So we have to take that into account. So basically, the first hypothesis is that J responds to C and F much faster than C and F responds to J. So the index responds to the number of chartists and fundamentalists much faster than the number of fundamentalists and chartists to changes in the index. So that's his first hypothesis. And he says changes in C and F can cause changes in J within minutes or within seconds, whereas the changes in J have much slower feedback onto C and F. Okay, so you can go through these are some of the hypotheses. That's one, and hypothesis two is if C is small, that is speculators is small, then J is a continuous monotonic increasing function of F passing through the origin, something like this on the left hand side A. So when the speculators is very, very small, then the market is some kind of smooth monotonic equilibrium market. But if C is very high, the F equal to 0 becomes unstable point. Very close to F becomes unstable point. The market goes either bullish or bearish, and there is a discontinuity that happens at very close to F. And very close to number of if the C is very high, that the speculative is very high. So this is the cusp catastrophe model that he used. Will be elaborated more by Petri and Vishu. Okay, so you have these models. Now these class of models they are there in finance, which were ignored. But now if you actually think of that, okay, there is a dynamics that happens in the financial market, and we know now how to connect the macroeconomic system and financial system through a consistent accounting framework. Now Yeah. It's a long term, yeah. Yeah, you read the paper. I can't get into that right now because the paper tells you exactly. He talks into this issue of the fundamentals have a long-term view of the fundamental value, and the time scale at which they change is very different. Okay, so see, I don't want to get into that technical discussion now. It'll be picked up by both Vishu and Petri. I'm sure the way you take that time scale difference into account. So you have this system. There is a financial system, and you have the macroeconomy. Now we know how to actually integrate these two in a consistent accounting framework. So now we are in a position to we can actually ask a question. When policymakers ask, how long will this recession last? Now we can actually say that, well, if you use this framework, you may get some idea. So given the nature of the boom, if the boom is consumption-led, debt-led consumption-driven boom, which is heavily funded by credit, which the credit expansion is through innovation in financial markets, whereas the total investment, the proportion of total investment where the financial investment is dominating than real capital accumulation that we saw, the data actually shows that the profit rate is high, but the capital accumulation is low. So if you have this kind of a characteristic, the crash in the financial market creates a recession in the economy, right? Sudden crash. So first, the firms have to deleverage. Okay, they have heavily invested. Both the non-financial corporations and the financial corporations, they have to deleverage. And homes, people sitting on property prices, as you saw in the in stock flow, in the data, that they are sitting on negative equity. So the demand is compressed from both the investment side and the consumption side, because both of them are deleveraging. On top of that, if you actually apply austerity, you're compressing real wage. Now this is going to take a hell of a long time to come back into the original growth path, because there is no investment, exogenous investment coming from the government or anyway. So this way of thinking is, you can only get through this kind of, synthesis. You have financial market, you have real economy synthesized in a consistent accounting manner, and using the methodological innovations from places like catastrophe theory and what mathematical ecology people have been working on this literature called critical transition, and people like Petri Piroin, and who have been looking at the discontinuity in the system. And this is what we are aiming at. Okay, and this is if I want to give I took a long time, but give an overview to leave you now to both Vishu and Petri to pick up from here, and Srikanth will talk about the systemic risk in terms of how they look at it through networks. This is the vision. This is what we want to understand. Okay, it's not just macroeconomics and finance sitting on its own. And now we have the substantive apparatus framework and the methodological tools and techniques and ways to think about the problem. Now I think we might be able to see the difference. Okay, I'll leave it here. Vishu?
Has been picked up by kind of mainstream kind of finance people.
Can you read in the mic?
Yeah, so basically not in the manner you were trying to say, but in the form of thought behavior and noise traders.
When you say mainstream, who do you mean?
I don't know. Because you said that, I don't know how it missed the finance people.
The DSG, when I say mainstream, I definitely mean the group that are still working on dynamic stochastic general equilibrium models.
So for the same group, like this has been picked by herd behavior and how the kind of activity of noise traders actually, what you were calling chartists, are basically
he
noise
also calls
traders.
noise, yeah.
So how the activity of noise traders affect kind of market, and how they behave in the or you can say in the boom and the bust behavior period actually. So this has been taken in terms of.
No, it's not clear how they have taken it. You see, if they have already taken that into account, there has to be a story to link that this actually causes aggregate demand problems. Okay, the issue of effective demand is never been acknowledged, and that is what is going on. The problem of austerity policies and where they come from, the intellectual apparatus of DSG models, is that you're still harping on incentive problem, incentive incompatibility, and regulatory. So there is no theory of how the financial or this kind of a let's say even catastrophe model of Zeeman actually impact aggregate demand. Okay, that story is still missing in the mainstream. There's still, whether they might acknowledge or not, even the new synthesis of what they call inflation as excess aggregate demand and so on, they still have to go some way to say that, actually acknowledge that it can actually impact aggregate demand. It is the demand that is actually creating the issue of making the lack of demand is what making the system linger in this state for a longer time. That acknowledgement has still not come forth. Otherwise, you would see the policy change. See, the policy change is not happening. You're still talking about deleveraging. Entire QE, quantitative easing, is about getting the balance sheet of the firms cleaned up so that they will lend again. And it's still a supply side logic. You lend more so that they will invest and they will create employment. That is what one is trying to articulate, an alternative view or alternative way to understand the dynamics. Vishu? No, I had it in the original sequence. Something happened at the end. I'll sequence it. Sequence, yeah, I will do it. Yeah, something happened at the end when